It didn't start with a crash, it started with a lie. A quiet lie told in boardrooms, whispered through phone lines, disguised in spreadsheets. A lie that would spread through Wall Street, infect the global economy, and bring the world to its knees. This is the story of Lehman Brothers, the bank that broke the world. For more than 150 years, Lehman Brothers was synonymous with success. It began in 1844 when a German immigrant named Henry Lehman opened a small dry goods store in Montgomery, Alabama. His brothers joined him, and together they discovered something more profitable than fabric, cotton. The Lehmans began trading it, financing it, and soon controlling it. They didn't just sell, they invested, they loaned, they built. By the dawn of the 20th century, the family business had moved to New York and evolved into an investment bank. Through wars, recessions, and revolutions, Lehman Brothers survived. It financed railroads, factories, and oil empires. It helped build America's industrial age. But with every decade, it changed. From merchant banking to modern finance, from partnership to corporation, from stewardship to speculation. By the 1980s, Lehman wasn't about building things. It was about building numbers. Bigger, faster, riskier. The new era of Wall Street had no patience for caution. Deregulation opened the floodgates. Credit became infinite, greed became normal, and leverage became an art form. Lehman Brothers was reborn under men like Dick Fuld, a CEO so feared and admired that employees called him the gorilla. He ruled the bank with an iron will and an obsession for growth. To Fuld, profit wasn't a goal, it was survival. In the early 2000s, a new drug hit Wall Street, real estate. The American dream had become a tradable asset, and banks learned how to turn mortgages into gold. They bundled home loans, good and bad alike, into complex securities called mortgage-backed bonds. Then they sold those bonds to investors around the world. The system fed itself. The more houses sold, the more loans written, the more profits printed. Lehman Brothers became one of the biggest dealers in this new game. But there was a problem. It wasn't real. Many of the mortgages inside those bonds came from borrowers who could barely afford them. The so-called subprime loans were ticking time bombs. Lehman's traders knew this, but they also knew the bonuses were massive. The culture was clear: make the quarter, move the stock, get the bonus. Tomorrow was someone else's problem. By 2005, Lehman's balance sheet looked unstoppable. The firm was making record profits. Dick Fuld was earning tens of millions a year. CNBC called him the king of Wall Street. But under the surface, the numbers were built on borrowed money. Leverage stacked upon leverage. For every $1 Lehman actually owned, it had borrowed 30. It was a skyscraper built on sand. Inside the trading floors, warnings began to appear. Risk managers raised concerns about exposure to mortgage debt. Analysts noticed the firm was holding billions in questionable securities. But inside Lehman, bad news was unwelcome. Traders who questioned the system were silenced or reassigned. The culture rewarded belief, not truth. When housing prices began to fall in 2006, the illusion cracked. Suddenly, the bonds everyone thought were safe started losing value. Investors panicked, but Lehman's leadership doubled down. They didn't unwind their positions. They expanded them. They bet that prices would rebound. It was pride disguised as confidence. By 2007, the storm had arrived. Bear Stearns, one of Lehman's rivals, began to collapse under similar risks. The market froze. Lehman's stock plunged, yet Dick Fuld told employees, the worst is behind us. Inside, executives scrambled to hide losses. They created accounting tricks like Repo 105, a maneuver that temporarily removed billions of dollars in debt from their balance sheet to make quarterly reports look healthy. It wasn't illegal, but it was deceitful. It made the company look solvent when it wasn't. Behind the scenes, the Federal Reserve and the U.S. Treasury were watching. They knew Lehman was in danger. They also knew that if it fell, the damage would be catastrophic. But there was one problem: public opinion. After years of record profits and arrogance, no one in Washington wanted to save another Wall Street giant. The mood had shifted from admiration to outrage. By mid-2008, the cracks were turning into fractures. Lehman tried to find a savior. Suri talks with Bank of America, Barclays, even the Korean Development Bank. But no one wanted to touch it. Every day, the stock fell lower. On September 10th, Fuld told his employees to stay the course. He believed the government wouldn't let Lehman fail. After all, Bear Stearns had been rescued months earlier. He thought the system would protect him. He was wrong. September 15th, 2008. The day the lights went out on Wall Street, Lehman Brothers filed for bankruptcy, the largest in U.S. history. The company had $639 billion in assets and $619 billion in debt. In the blink of an eye, 25,000 employees lost their jobs. Decades of legacy vanished overnight. The shock was instant. Markets around the world went into freefall. Banks stopped lending to each other. Confidence, the lifeblood of capitalism, evaporated. Within days, the crisis spread to Europe, Asia, and beyond. It wasn't just a financial collapse, it was a psychological one. But here's the truth. Lehman's failure wasn't an accident. It was the result of a system that rewarded deception and punished caution. Every player, bankers, regulators, politicians, had incentives to keep the bubble alive. And when the music stopped, no one wanted to admit who was responsible. Inside Washington, panic set in. The Treasury Secretary, Hank Paulson, himself a former Wall Street CEO, faced an impossible decision: save Lehman and fuel outrage, or let it fall and risk collapse. He chose the latter, but within days, the contagion forced his hand. AIG, the world's largest insurer, was collapsing under the same toxic assets. This time, the government stepped in. Hundreds of billions were printed to stabilize the system. The message was clear. Lehman was a sacrifice. In the aftermath, hearings were held. Executives testified. Fingers were pointed. Dick Fuld appeared before Congress, defiant and unrepentant. He claimed the collapse was unforeseeable, that the firm had been a victim of rumor and panic. But emails and internal memos told a different story. One of arrogance, manipulation, and willful blindness. The human cost was immense. Families lost savings, homes, and pensions. Millions of people who had never heard of Lehman Brothers lost everything because of it. In New York, former employees packed their desks into cardboard boxes and walked out past television cameras. The image became iconic, the fall of modern capitalism captured in a single shot. What followed was a global rescue. The U.S. government and central banks around the world injecting trillions to prevent total collapse. But the deeper question remained: how could this happen? How could one institution bring the entire system to the edge? The answer lies not in one company, but in the culture that built it. Lehman Brothers didn't invent greed. It perfected it. It mastered the art of illusion, of turning risk into reward, debt into profit, lies into balance sheets. It was a mirror reflecting everything we wanted to believe about endless growth and invincible markets. And when the mirror shattered, we saw ourselves. After the crash, regulations tightened. Politicians promised reform. Wall Street promised humility. But within a few years, bonuses returned and markets soared again. The lessons of 2008 faded into background noise. The same tools, leverage, derivatives, shadow debt returned under new names. Today, Lehman Brothers exists only as a memory, a ghost haunting the skyscrapers it once ruled. Its name still echoes through textbooks and documentaries, a warning that nothing built on illusion can last. But the machine that created it never stopped. It simply evolved. The collapse of Lehman wasn't the end of an era. It was the beginning of a new one, where crashes are managed, not prevented, where moral hazard is policy, where capitalism survives by rewriting its own rules. The next crisis won't look the same. It will be faster, quieter, digital, but it will be born from the same human flaw, the belief that we can cheat gravity forever. Lehman Brothers was not destroyed by the market. It was destroyed by the myth of control, the belief that numbers can erase consequences, the arrogance that the game will never end. But every empire built on illusion eventually faces reality. The day Lehman fell, thousands of traders stood frozen as the ticker went dark. Phones stopped ringing. The room fell silent. Some wept. Others stared. The system had finally met itself in the mirror. And for a brief moment, the world remembered. The trust, not money, is the foundation of everything, and once that trust is gone, no bailout can bring it back.